In this video, we are going to talk about the power of dividend investing, the snowball effect. So before starting this video, please like this video and subscribe to our channel for future updates. Interest generated on money that was previously earned as interest is known as compound interest. This cycle, commonly referred to as exponential growth, results in rising interest rates and account balances over time. The term snowball effect is frequently used to describe the idea that a little snowball that rolls down a hill and gathers snow rapidly grows into a very huge one. But when the snowball rolls downhill, it increases its mass gain rather than merely increasing in size at a steady pace. This is due to the fact that as it becomes larger, it gathers more snow with each revolution, as the snow from its prior revolution is now in touch with the ground and is being added to the snow already on the ball. This, in our opinion, is applicable to premium dividend growth stocks, including dividend aristocrats and dividend kings, which have raised their dividends continuously for more than 25 and more years, respectively. This explains how to invest in successful companies and use the snowball effect to increase your wealth and income several times over. Although these sources of money are everywhere, an empirical example, probably the most potent wealth-generating device on the planet, is compound interest. It's really thought that Albert Einstein referred to it as the eighth wonder of the world. Assume you lend $100 at a rate of 5% interest compounded yearly to better demonstrate this idea. With a $100 investment, you would have made $5 in the first year, giving you $105 at the beginning of the next year. In contrast, we are now getting 5% interest on $105, which means that we would receive $5.25 in interest overall for the second year. The interest we would receive in the third year would be $5.0525, or 5% on $110.25, and so on. In 20 years, your $100 will have increased to $265.33. If it had merely paid a consistent $5 a year instead of compounding, your investment would have only increased to $200. As you can see, this can result in exceptional returns very rapidly. In this example, compounding added a 65.3% boost to returns over a 20-year period. The snowball effect in practice. Having witnessed its ability to boost profits, how can you use the snowball effect in your investments to make the compounding impact work in your favor? We only need to look at Warren Buffett and Charlie Munger, who are perhaps the greatest investors in history. Warren Buffett says that all there is to investing is picking good stocks at good times and staying with them as long as they remain good companies. The secret to successful investing is contained in these three seemingly straightforward statements. 1. Recognizing long-term compounders. 2. Securing favorable compounding rates. And 3. Having the patience to let the snowball effect operate in your favor. Though it might be challenging to identify long-term compounders, they are usually characterized by high returns on equity and significant, long-lasting competitive advantages that enable them to maintain their high returns on equity over extended periods of time. Why are these two characteristics so crucial? As noted by Charlie Munger in the following quotations, because it is the single most significant determinant in determining the return on investment you will receive over the long run. Return on equity is extremely essential. It's difficult for a stock to provide a higher return over the long run than the company that supports it. Even if you originally purchased the company at a significant discount, you won't get much more than a 6% return if it yields 6% on capital over the course of 40 years, and you retain it for that long. On the other hand, even at a price that appears exorbitant, a corporation that achieves an 18% capital gain over a 20 or 30-year period will yield an incredible return. You will lose out on the whole advantages of compounding if you are forced to trade in and out of equities, often since they are losing their competitive advantages and consequently their capacity to compound equity at favorable rates. If you purchase something that compounds at a rate of 15% annually for 30 years and you pay a final 35% tax, the final result is that you keep 13.3% year after taxes. In comparison, your return would be 15% minus 35% of 15%, or merely 9.75% annually compounded, if you purchase the identical investment, but were required to pay taxes each year totaling 35% of the 15% that you received. That makes a difference of more than 3.5%. Furthermore, it is really illuminating what 3.5% does to the figures over protracted holding periods like 30 years. Examples of snowball effects. Dividend growth stocks include a large number of firms that have the long-term competitive advantages required to compound equity at high rates of return over an extended period of time. These are equities that have a track record of raising dividend payments to shareholders year after year in addition to providing them with excess cash flow. Due to the twofold compounding impact this produces, investors' dividend income stream grows exponentially. As we will see in the following cases, this situation results in an annual rise in the investor's yield on cost, i.e. the amount of dividends received relative to the initial dollar amount invested in each share. Over time, this leads to some incredible wealth-building outcomes. Coca-Cola. One of the biggest beverage firms in the world, Coca-Cola, KO, is a prime example of a long-term compounder with enduring competitive advantages that has produced exponential returns for investors with a lengthy time horizon. It has more than 500 distinct non-alcoholic brand licenses or controls them. Since its establishment in 1886, the corporation has expanded to more than 200 nations, and its brands are responsible for nearly 2 billion daily beverage servings globally, generating about $35 billion in sales annually. Due to its strong brand recognition and mouth-watering products, it has amassed a devoted consumer base that allows it to raise prices and, over time, multiply investor wealth at double-digit rates. True enough, its dividend cash payout per share has increased by 2,360%, making it an outstanding dividend growth company as well. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. In the end, thanks for watching, and see you next time.